Hello, chart watchers, and welcome to this Friday, August 2nd, Market Watchers live show with your hosts, Tom Bowley and Mary Ellen McGonigal. For those of you joining us for the first time, a welcome to the show, and for our regulars, welcome back. Taking a look at today's market action, you can see that the selling continues for a third straight day. Dow Jones Industrial Average currently down 243 points, the S&P 500 down 30, the NASDAQ down 129, and the Russell 2000 getting hit hard again, down another 19 points. Just Wednesday, we were testing that 1600 level, now back all the way to 1530-ish. 10-year Treasury yield continuing to move lower since that Fed meeting. We've now dropped about 20 basis points. Volatility index, as you can see, absolutely skyrocketing here over the past few days as the market feels the effects really of all of the selling that's taken place. Utilities and real estate, two defensive groups moving higher. And have been over the past few days since that Fed meeting. Meanwhile, you can see technology, one of the more aggressive areas and the best performing area in 2019, falling the last 3 days. A lot of profit taking there. Energy continues to weaken. Yesterday, we did break below gap support and price support near 62, and that selling continues today, down another 1.4%. Internet stocks struggling, moving back close to gap support. That was where we were before Google came out with its earnings, and we saw that huge gap up in internet. So we are filling that gap. You can see some of the oil stocks here breaking down below key lows after really putting in about a triple top. This is a new low that's been forged over the past 6 weeks or so. Financial administration stocks down for the fifth consecutive session. This time it's Square. Had been PayPal that had been struggling. Now we've got Square. They came out with their earnings. They did beat top and bottom line, but the reaction is very negative here to the downside, down 15%. That is certainly weighing on the financial administration stocks. Transportation services doing extremely well today. I don't have a chart up here, but you can see one component, XPO Logistics. This is how crazy the market is. Square gets they beat their top line, beat their bottom line, and you can see the stock down 15%. XPO Logistics missed on their revenue estimates, lowered their revenue guidance, and the stock's up 11%. Sometimes things don't make perfect sense, Mary Ellen, but that's where we are right now.
Yeah, I'm going to cover Square a little bit as far
I'm going to cover it as well, and I think it's an interesting stock, so I think it'll be good to take a look at it from a couple of different perspectives.
Mm-hmm.
Yeah, but it's been kind of a crazy couple of days.
It felt very fragile going into the week, and then we could see just how fragile the markets were with their swift and clear reactions to headlines, mostly negative.
Yeah, I was talking to Greg Schnell 2 days ago, and we were just chit-chatting, and I was very bullish, and he was very bearish. And I'm going to give him kudos because he was telling me 2 days ago things were rolling over. That was right before the Fed. Now, of course, he didn't know the Fed news, and he didn't know the tweets coming out that kind of led to the market's implosion here. But he said his charts, he was feeling a little bearish. And
yeah, I think he's probably looking at breadth and lack of. I'm actually, my article for the weekend is going to talk about gaps up, and over 150 stocks gapped up on earnings this week. So there are still things popping. There are still pockets, but overall, there's a definite heaviness in the air.
Yeah, and we're going to talk a little bit about seasonality in a bit too, but August and September since 1950, those are the only 2 months in the year that the S&P 500 has produced annualized returns that are negative. Both months, and they're the only 2 months, and here we are, it's August 2nd.
I believe it.
Yeah, we got some seasonality headwinds that we got to deal with as well. But anyhow, we got a busy schedule ahead. So what do we got going today, Mary Ellen?
Yeah, so today we are going to be reviewing certainly your seasonality. I will be taking a look at what is hot and what is not, given the action in today's markets or in the markets this week. And then we'll be going ahead with our 10 in 10. So if you have any ticker symbols that you'd like us to review, go ahead and input those. And yeah, that's it. And we're going to see if we can get to that poll. We'd love to hear your thoughts on the markets as far as how low do we go?
Yeah, that's a good way of putting it. How low do we go? Let's go ahead and jump into economic reports. We do have a big one today that came out, of course, and that was the non-farm payrolls. So we had July non-farm payrolls coming in just a little bit ahead of expectations. Private payrolls came in a little below expectations. Unemployment rate 3.7% versus 3.6%. The hourly earnings matched, and July consumer sentiment matched, and then June factory orders came in a little bit lower than expected. So what does all that mean? Well, I'm not sure how much that means or what that means, but I can tell you one thing, that since the Fed meeting on Wednesday, I'm not sure whether or not Jerome Powell is watching the show, but if he is, this is going to be charting 101 for the Fed. The 10-year Treasury yield has now dropped 20 basis points since that meeting. I think if the Fed didn't understand the message from the bond market before, hopefully he's getting this one, because the Treasury market is saying we are going to see some additional rate cuts down the road. And granted, I know the 10-year Treasury yield doesn't track the Fed funds rate. We're talking about maybe two different animals, but it does tend to forecast what the market is expecting. And I believe the message is pretty clear. And that is that the bond market believes we are going to have additional rate cuts. And I agree with them. I think the Fed will again change their stance in about 30 days. But in the meantime, we'll just let them have their fun, whatever they're trying to do. As far as earnings reports go, we had a number of earnings reports out last night and again this morning. And you can see a bunch of them on your screen. Literally, if I put them all up here, I think yesterday was the heaviest day of the quarter for earnings reports. So I literally could put up about 100 slides to go over all of them. These are some of the key reports. I'm sure there's some others that everyone else out there thinks are key, but these are some that I was kind of watching heading in, and some of the big names and so forth. As far as the charts go, I really want to start with Square, because this is one that I really thought I figured they were going to come out with good numbers. They had been trading on a relative basis pretty strongly here versus the financial administration stocks going into its earnings report. And the thing is, they did. They reported nice numbers. Square came out. They had their earnings per share come in at 21 cents versus the 16 cents that was expected. They beat on their top line, 563 million versus 557.7 million. But the reaction very negative here, and you can see going back and challenging what I think is going to be a pretty important support area. I think Square needs to close above 70 here, or I think that opens up the bottom that we saw back in June, closer to 60. So unless we get a big reversal, we've got a lot of volume. If we can put a long tail in, come back up, close at or near the high, then I think we could have established a bottom with major volume. But if we don't, and we come back down and we fail to hold this level, we've already lost the moving averages. I think losing this price support would really be kind of a nail in the coffin here, if you will. So Square is something that I would be watching pretty closely. Another stock, MSI, is one that I wanted to point out here, because MSI was another one that I thought was going to report pretty good numbers, and they did. They came out, they beat their top line, they beat their bottom line. They gave mixed guidance going forward. They said Q3 earnings per share would be lower, but fiscal year 19 earnings per share would be higher. So the market, I think, initially took that as a negative, went down, but look at the reaction here. You've got one of the leaders versus the S&P and versus the telecom equipment group. So you got a really good relative performer here. We had gap down, I think now rolling higher, close above that prior high. I'm going to say around 173, 174 today would be really bullish. I'll be watching for that. Pinterest came out with its earnings report, and they beat on the top and bottom line. They guided fiscal year 19 revenues higher. Why do I think this is big? Well, obviously the stock's up 21%, so that's going to be pretty big. But then also, if I annotate here, I think it's pretty clear after they went public, they stopped right above $35 after that initial move. Look at where we stopped today, 35.21. We tested that area. Breakout would be very bullish for Pinterest. If we fail, we may work our way back down to maybe a rising 20-day, maybe even back to test gap support. I don't know that we'll go back that far. A lot of volume coming in on this move too. So I think the way we finish today will be really important for Pinterest. Let's take a look at XPO. Now, this one is one that just sometimes you just kind of shake your head when you see results to earnings reports, and I think this is one of them for me. XPO Logistics. So they come out, they say, well, we missed our revenues, 4.24 billion versus 4.37. We did beat on the bottom line, though, 128 versus 124. And by the way, we're going to guide our fiscal year 19 revenues lower. and the stock gaps up and is up 11%, breaking above key resistance. I follow the charts more than I do the announcements. I think that the charts tell us something. If we're getting this breakout to a multi-month high and we are seeing relative strength break out to a level we haven't seen in 7 or 8 months, to me, this is more important than the news that just came out, the fact that they missed. I'm not going to trade it because I don't trade companies that miss revenues or miss earnings per share, but technically I do like what's going on here with XPO. All right, heading over to the dashboard here for a second. Down below, you can see Bio right here. I wanted to go ahead and point out this stock because it is making a move on the scooter movers. And when we actually, I don't want to annotate it just yet. I want to go back a little further. Let's go back a couple years. And I think we are at a really key level right now. And that is when you look at the 2-year chart and we annotate it here, you can see that right there and then right here, a couple of big areas of resistance. We're in the middle of it. So while today's move to the upside is pretty important, I think that we still got some work to do. If we could break above that August high with, I think the scooter mover may be an early indication of something we want to watch for. So that's how I use the scooter movers a lot of times. I like to see whether or not we're breaking above key resistance levels. I think in the case of Bio, if we can get through that 345 area, that could be a really good thing. So for that reason, Bio-Rad Laboratories is my scooter mover of the day.
Very good. I'm going to go ahead and get right into upgrades and downgrades. There were not a lot in the way of upgrades today. There was a major Wall Street firm that is initiating coverage and buy ratings on several of the FANG stocks. So the first one here is Amazon. And the stock has been in a bit of a free fall here, falling on quite a bit of volume, and this is not what you want to see. The stock has broken below this 50-day simple moving average. Your RSI and your MACD are now negative. My next area of possible support will be that 1750 level. I would need to see that hold there to deter any further downside. Another FANG stock, Facebook, got upgraded or covered with a buy rating. And this is another one of these large mega cap stocks that is just in line with the broader markets, selling off after hitting a near-term high in price. And we can see also here that RSI, MACD just poised to turn negative. We are finding support at this upward trending 50-day simple moving average. So that is good for now. And then Google was another one that was put out with a buy rating. And let's just see if we can pull this one up. And we can see the stock had this big gap up last week on earnings. Really nice orderly pullback here to this upward trending 10-day simple moving average. Google's uptrend still remains firmly in place, both RSI and MACD trending upward. Let's go ahead down and take a look just at a couple of these downgrades. ABMD. The company, they revised lower the estimates. Take a look at this gap down following earnings yesterday's that were weak. Today, we're seeing more deterioration following those downgrades. So ABMD does not look healthy. We can take a look at NTAP, and the company came out and they lowered guidance. And take a look at this. The stock's down 22%, already had been in a very confirmed downtrend, huge volume on this gap down. So I would urge you to stay away from this stock. I was just going to mention Square only because they did come in with good numbers. They were downgraded, had everything to do with their volume of payments. Their payment volumes dropped, and that's a critical metric for these payment processing companies. I think Tom already covered it very well as far as the chart, and that is your upgrades and downgrades. And you can see the stocks that we covered here on the screen. Let's go ahead and move right into upgrades and downgrades. I'm sorry, what's hot and what's not. And there actually were pockets of strength this week that we are going to go ahead and review. A lot of these are going to be earnings related, but there were some that were news related as well. This first, pardon me, stock is a prime example. This is Mylan, MYL. And earlier this week, the company announced that they are going to be merging with Upjohn. Upjohn is a major component of Pfizer. Analysts like the news. Take a look at this huge volume on Monday on that gap up on the news. The stock very nicely orderly pulling back to that upward trending 10-day simple moving average. So this downtrend reversal is still in place. Also in that healthcare space, Humana was up this week, and this is everything to do with Medicare Advantage. The stock gapped up here. It's up about 6.5% on the week and retaining that gap up, not giving much back in very bullish fashion. Amgen, another healthcare stock that is having a good week. Let's see if I can get that ticker symbol up and we can take a look at the stock. This company, they did come out with earnings, but they talked about they had a breakthrough with a cancer drug, and that has everyone excited. The stock had this big gap up on Wednesday, and it is again retaining that gap up. Stock's up about 7% on the week. And one last healthcare stock is a company that came out, they beat, not only did they beat their guidance, they also raised guidance going forward. So this is a near-term downtrend in the stock after it hit a new high at the end of June. Now we can see that this downtrending period has been reversed. We've broken up above these key simple moving averages, RSI, MACD, just poised to turn positive. So depending on market conditions, of course, we could easily see more upside here. I'm going to move on to some of these retailers that had surprisingly strong weeks, but again, they are all going to be news related. The first one is Nordstrom. These department stores have really been suffering in the face of internet retail, but Nordstrom had a pop here. It was all about speculation. They're thinking that the company may go private. So we did see that big pop on Wednesday, mostly get given back over the next couple of days because of tariff-related fears. So we're not quite out of the woods. I was looking for this particular stock as well as others in this area to potentially at some point reverse that downtrend. Not quite there. If we can close above that 50-day simple moving average, it would be more encouraging, but of course the news is speculative, so not as worthy of taking action on. Big Five, another retailer, these guys, very confirmed downtrend, came out with strong numbers. Stocks up about 28% on the week. They're a little further along as far as potentially reversing this downtrend. Your MACD not quite positive yet, but your RSI is positive. It's a $2 stock. I would generally not play in that playground, if you will, but you could see a little more of a continued advance given the huge volume on the move. One last retailer here, Restoration Hardware. This company has this gap up here on earnings. It's been in a very nice uptrend, but we can see that this gap up earlier in the week, they're given most of that back. But the reason for this is the company came out and raised guidance, and subsequently that big move up has been pulled back, but the stock is still very much in an uptrend, finding support, upward trending 10-day simple moving average. Your RSI and MACD are both positive. I'm going to move on here to another area that has some positive and some negative areas, but we are, of course, talking about what is hot. So I'm going to share with you some internet stocks that are up this week. This is all about earnings. This is Akamai, AKAM. Stock on this earnings report gapped up. Take a look at that earnings, and we can see that there's a subsequent advance following that. They blew out their numbers. Stock broke out of this nice base, broke out of a new high at above this 88, very bullish. RSI, MACD are positive, but you do like to see that volume. That's telling you institutions went in and the stock could easily trade higher. I'm going to move on to software, a couple of stocks here, all about earnings. This is Ring Central, RNG. Again, gap up here on earnings, huge volume. I think what you're going to see here is a bit of consolidation after that significant upward move. Perhaps the stock trends sideways before potentially having another leg up. Surprisingly, semiconductors, I'll tell you this semiconductor, we can just take a quick peek here. The index for the week is down 7%. A lot of that is tariff related, the recent deterioration there, but there were some bright spots on the hot side within semis. This first one is Lattice Semiconductor, LSCC. Company came out with earnings. They reported their highest profitability in 10 years. Again, gap up, huge volume, really holding in well despite the pressure among its peers. One other semiconductor stock that we can take a look at is Tower, TSEM. Good company. Good earnings report. And the company is boosting their production capacity. So analysts like what they heard. We can see the stock has broken out of this very long base at about 19, and now we are in a back and fill period following that breakout, but generally quite bullish, again, particularly given what is going on around it as far as other stocks. We can take a look at a couple of other semiconductor stocks, mostly because it's notable when you have a group that is really seeing deterioration, and yet there's a stock among that area that is withstanding those downward pressures. And the idea is once those pressures are lifted, these stocks could very well be your leaders. Now, PKE is Park Aerospace. This is a smaller company, but take a look at this nice saucer-based formation here. The stock is poised to break out at about 18 and a half. Very confirmed uptrend, finding support at this upward trending 10-day simple moving average, RSI, and your MACD are both positive. Now, we have to, of course, take a look at what is not hot, and I'm sure we could fill quite a bit of airspace, if you will, but we can begin here because semiconductors, I talked about the overall trend down 7% for the week, the semiconductor index. So let's take a look at some of the heavyweight names in there. These are going to be stocks that are more heavily impacted by China trade. In other words, they do more business there, more of their revenue is derived. So AMD is a prime example. This is advanced micro. We can see this break below that 50-day simple moving average. Big volume, not what you want to see when a stock breaks support. We can see that this RSI MACD just is negative, and this MACD is just poised to turn negative. Continued volume on the downside, signaling more potential downside ahead. So we can go back historically. Of course, this is that drop last fall, but when these bigger names drop below their 50-day simple moving average, and you start to see a shift in the volume characteristics where there's more volume on down days than up, you could get into trouble. We're not quite there yet, but it does not look positive. XLNX, this is Xilinx, another semiconductor stock. See if I can get the ticker symbol in there. It's down, about 6% for the week. We can see that it broke down. It'd be interesting to see where the stock closes for the week, but generally speaking, with this RSI trending downward, we had this negative black line through the red crossover on the MACD poised to turn negative. You can go back here historically. This can be helpful. This is a period, this is when Xilinx reported earnings that did not meet expectations. The stock gapped down, but what we want to pay attention to is the action subsequent, because you can see that once it breaks that 50 on the RSI, it can stay down here for some length of time. So we are going to, of course, be keeping an eye on this type of action. Can it find support at this upward trending 200-day moving average? And these are the dynamics that you want to be on the lookout for as far as a downtrend reversal. It starts breaking back up above simple moving averages, your RSI and your MACD trend upward. So let's go ahead and move on to other areas that are not hot. And some of these pharma stocks got hit. And the first one is Pfizer. I talked about their Upjohn division being merged with Mylan, but Pfizer, the move had a very opposite impact on Pfizer. Take a look at this big gap down, huge volume. Stock is down again. It's down about 10% on the week. So Pfizer is really suffering. They were not in such good shape prior to the announced merger, but they are continuing to deteriorate. Another big pharma stock, LGND. This is a company that really has not been able to get off of the mat, if you will. It's been knocked out, but more recently it did dip again, and that is going to be earnings related. Other areas of healthcare, we can take a look. Some of these hospital stocks did get hit. This is HCA, and the company actually was on track. It actually had hit a new high in price, but this particular gap down is all about earnings. So they gap down, prices now below these key moving averages. Again, you want to see volume, and in this case, on the negative side, it broke down on this huge volume. We're seeing continued deterioration in HCA. A lot of this has to do with the fact that the stock was hitting a new high, essentially priced for perfection. So any kind of weakness, and the stock, of course, got slammed. CYG, this is another, see if I can get that ticker symbol in there. This is another hospital stock, and see if we can get the right ticker. Well, I am going to move on to one other one, HLTH, that is in this space. And we can just take a look at this name because there we are. Another one that really was dead in the water prior and is continuing to deteriorate this week. I'm going to move on because some of these airline stocks are not doing well this week. This is Southwest Airlines, and there was hope for these airline stocks as traffic was improving, their load rates were improving as well. But we can see this week that in this case, this particular stock is deteriorating. They came out with good numbers here, but since then we've just seen this very general pullback. So the stock is now in a confirmed downtrend. It's broken below support. RSI, MACD are both negative. Hawaiian Airlines, HA, is another stock. This company is seeing a lot in the way of competition, more airlines moving into their space. It's just been bouncing around here below this downward trending 200-day simple moving average. The stock is down. Actually, it was down quite a bit more, but it's down probably about 2.5%. SAVE, this is the low-cost airline, and we had talked about this one last week because they came out with poor numbers and they gapped down on those poor results, but the stock is continuing to come under selling pressure. It is trading downward again today. I want to move on to another area that's getting hit, and some of this is consumer these are consumer stocks. Some of it is tariff related, but also earnings related. This first one is UA. This is Under Armour. This is another company that was priced for what I would call perfection. It hit a new high just before releasing their results. Of course, in that instance, any hint of potentially negative report is going to get hammered. It did. It gapped down, huge volume, continuing to deteriorate. The stock is down over 6% on the week, has now broken below this key 200-day simple moving average. Huge volume indicates more potential downside ahead. Another consumer-related stock, and this one is just simply pulling back. This is CarMax, another name that had hit a new high in price. It's pulling back this week, and we can see it's down probably about 4%, but it's really still in good standing. We can go back here historically where it's been able to break below this 10-day simple moving average and recover just nicely. DLTR, this was a winner earlier in the year, Dollar Tree, but we can see that it has really fallen out of bed. And I will tell you, this is a prime example of when you see a stock break below this 50-day simple moving average. We did have that break here in May, but I will tell you the broader markets were in a free fall back here. This initial break, the markets were still in good standing. And when you see that break, definitely an exit sign, need to leave immediately, and we can see the continued deterioration subsequent to that. We're a bit oversold, but by and large, this is not a healthy looking stock. So that is it for what's hot and what's not. We will be back. Tom is going to share with us August seasonality right after this break.
The ChartWatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the ChartWatchers newsletter.
Okay, welcome back, everybody, and it is time for August seasonality. What you have on your screen here is a seasonality chart of the S&P 500. It goes back over the last 20 years, and you can see a couple of things here. Notice, first of all, August and September are both negative over the last 20 years. I can tell you that these are the only 2 months that are negative over the last 70 years. If we look back just over these last 20, you can see actually there were a few other months, June, February, January, all negative as well. But also keep in mind that this, 10 of the last 20 years was in a secular bear market. So, I would be maybe taking this a little bit with a grain of salt, because again, you don't normally have 10 of your 20 years in a secular bear market. So I do think that is somewhat influencing these numbers. But August and September, I think if you go back the last 70, have been very weak on the S&P 500. And it's just something to know as we go forward. I would expect that this is going to continue probably over the next 70 years. I think that a lot of market participants go on vacation over the summer. So I think volumes go down. I think prices are easier to manipulate. And let's face it, September is the month, in my opinion, where dirty laundry comes out. If you have a warning in March, you can simply say, well, next quarter is going to be okay. June, you can say, well, second half of the year is going to be okay. By the time you get to September, if things haven't picked up, I think a lot of times companies tend to throw everything, all the kitchen sink at the market. And I do think that that's one of the reasons why September tends to be a very weak month, is that finally everyone just says, okay, we're not, well, the poor performers anyway say, okay, this is not going well. We're going to take a hit. We might as well just throw everything in there, be done with it. And so I think that's why the market tends to find a bottom in the month of September toward the end of the month. All right, as far as the individual indices, you can look at this for a minute while I just give you a couple of numbers. The S&P 500 has gone up more than it's gone down in August. It's gone up 38 times, down 30. But the annualized return is actually negative. It's less than 1%, but it is still negative. And it ranks 11th out of the 12 calendar months, with September being the only month that has been worse on the S&P since 1950. On the NASDAQ since 1971, we've seen August move higher 27 times, move lower 21, with the annualized return basically flat, also ranking 11th out of the 12 months, with September being the worst. And on the Russell 2000, we've been up 17 times, down 14 times since 1987, with an annualized return of just over minus 7%, which is the worst performing month of the year on the Russell 2000. So as we head into these 2 months, we shouldn't be doing a whole lot of expecting positive results, at least not from a historical perspective. So when we see the month start off this way, normally the beginning of August isn't this week, week as in WEAK, but we do know that this is the time of the year when the market tends to struggle. So for those of you maybe who are a bit more conservative, I would either be in cash or partly in cash, or maybe more into income-oriented stocks, a lot of the defensive areas of the market, like consumer staples, real estate, some of those things, utilities, tend to do better in the months of August and September. Speaking of consumer staples, let's take a look. Over the last 20 years, consumer staples has gone up in August 0.01% on average, and September 0.3%, I think 0.1%. I may have misspoke there. And you might think, okay, well, that's not much. But when you look at it on a relative basis, which is what this next chart shows us, This is the XLP compared to the S&P 500 over the last 20 years. August is 0.3% better than the S&P. September, 1.3%. So we are clearly seeing much more strength. And you can also see in terms of the percentage chance that August is going to outperform on a relative basis, 55% of the time, or roughly 11 of the last 20 years. Here, 58% of the time. So August and September do tend to outperform. We do tend to see outperformance in consumer staples during these 2 months. So something to keep in mind if you just wanted to be a little more cautious. I think that makes perfect sense given what we've experienced in the past. So what doesn't look so good? Well, I would be careful with materials. Number one, materials have been weak anyway. We've seen materials underperform the S&P 500 for the last 8 years. It started in 2011 when we put a bottom in the US dollar index. Since the dollar's been strengthening, we've seen materials on a relative basis lag the S&P 500. And historically, as we go into August and especially September, you can see the relative performance negative in both months, meaning that, well, this is on an absolute basis. If we switch over here to a relative basis, you can see they're both down on a relative basis as well. August does a little bit better in terms of its odds of outperforming, but the average is still negative, and you can see that really drops when you go into September. So I think the combination of what happens on an absolute basis and a relative basis tells me this is a group I want to be really careful about over the next 2 months. All right, so if we know that consumer staples is an area where we want to be, or at least to be considering, which stocks might we consider? And I'm going to go in and show you, first of all, how I would go about looking for that. If you start on your dashboard and under the member tools over here, under reports and analysis tools, here are your scooter reports. Here's the large cap. You can do the same thing with small cap. It's in scooter order, which is StockCharts technical rank, SCTR. Type in consumer staples in this box. Now, all of a sudden, all of the large cap consumer staples in scooter order come up. So here are the best performers. And you can see we quickly moved down below 70. We only have about 10 or 12 stocks here that are at 70 or above because we're in a bull market. And many of these consumer staple names are not doing as well as many of the more aggressive sectors. That's why you're not seeing very many here. But some are still doing very well on a relative basis, even though they're part of consumer staples. Look at Hershey's. So then the question begs, which stocks actually like August and September? So I would pull up the seasonality, that little snowflake. You can just click on that, and there's Hershey's, and that's 5 years, but let's go back 20. Well, Hershey's doesn't do well in August. It does very well in September, doesn't do so well in August. But if we look at the chart, you can see Hershey's looks really good right now. It's a staple name. Staples do well. Hershey's, yes, it tends to struggle maybe. But if we could get a test of, say, that rising 20-day moving average, knowing that consumer staples probably will outperform, that seems kind of interesting to me. Hershey's relative to the food products area, you can see performing extremely well, and relative to the S&P 500 doing very well. Food products just kind of going along for the ride, but you can see food products back in May when the market was weak went up. This is on a relative basis. Food products, October and November, when the market was weak, goes up. One of the things you need to realize, when the market goes down, more of these defensive areas outperform. Doesn't necessarily mean that it goes up. I mean, if you look over here, you can see actually the food products group in the month of October and November just went sideways. It wasn't going up, but the S&P 500 was getting killed. So as a result, the food products area was much better on a relative basis. Well, the last week or so, as the market has turned lower, you can see food products absolutely outperforming. But the good thing is with Hershey's is even if consumer staples underperform, you've got a really technically sound stock here with great volume coming in, and they've got pretty good chocolate to boot. But here is your relative strength, which I think is incredibly important. If I'm trying to outperform the S&P 500, but I want an element of safety, look at what Hershey's is doing. It's part of a defensive area, and it's outperforming the S&P 500. So that's kind of how I would review each of these stocks, and I'm going to go over some more of these with you. We'll go next with Estee Lauder. So last 5 years you can see, but let's go back 20. And August, not so great. September, not so great on a relative basis. What's the chart look like? Well, if we pull up Estee Lauder, you'll see that it's been moving up. Its peer group's been moving up. It's got a pretty nice looking chart. So what trumps what? Does seasonality trump the chart, or does the chart trump seasonality? In my opinion, the chart always trumps seasonality. Seasonality, I would use more as a confirming signal, or maybe let's take a look at maybe an argument against a position. So in other words, if I'm looking at Estee Lauder and I really like it, but then I pull up my seasonality and I see, well, August and September is not so great, then it probably tells me that either I want to take a smaller position, maybe I want to keep my stop really tight, because I don't want to get caught up in that historical downdraft that the stock has. So here with the pullback, I might say this breakout here occurred at about 180. Estee Lauder is in that consumer staples area. I can be conservative and I can keep my stop really tight. All of those things make sense to me. Next up is, let's type this back in again, consumer. All right, next up is Tyson. So here you've got Tyson, and this is one of the stocks actually in my income portfolio that I keep track of. August actually does go up 55% of the time, a little bit of positive action. September's positive, even though it goes up less than 50% of September's. So this isn't bad. I mean, the historical isn't painting a bearish picture. So let's take a look at the chart on TSN. And it's been I think it's in a really nice pattern here, actually. Even equal highs, higher lows, nice ascending triangle. It's got in the food products, which is just kind of going along for the ride. But if the market's weak, this is a group that will probably outperform the S&P. And you've got one of the leaders in the group. So I think that Tyson's looks like a pretty good candidate, and it pays a dividend. So again, for somebody who's more conservative, looking for a little income, wants to keep exposure in the market, but doesn't want to take the risks of owning, FANG stocks or these really aggressive stocks during 2 bearish historical months, I think Tyson's makes sense. Next up. All right. I'm not sure why it keeps going back there, but we'll just keep bringing it up here. Costco. Love Costco. Love shopping there. You can see August, not such a great month. September, though, pretty strong. Considering how weak the market is in September, that's a pretty impressive number for Costco. So what does the chart look like? Well, on the chart, I would say Costco looks pretty good. Yes, it's been pulling back with the overall market, but look at the relative strength. Costco outperforming the S&P 500 in a nice uptrend on a relative basis. The group, not bad. So, and this is personal products area. Yeah, I mean, I don't see anything wrong here. Here's your breakout. I mean, if you keep a stop probably pretty tight at that 50-day moving average. So maybe you give it, 3% to the downside to the 50-day moving average, and you're in a more conservative stock as we go forward. All right, next up is McCormick Spice Company. August and September are both positive, and look at the odds. So now all of a sudden we got a stock that looks pretty good from a seasonal perspective, but what does it look like on the chart? Well, just recently broke out here above some overhead resistance. That's good. It's been holding this area. I think 156 or so has been great support of late, and it's not that bad. Again, it's the area it's in starting to strengthen, not great food products, but on a relative basis, it's been holding its own on the S&P, and I don't think looks bad on a price chart. So yeah, McCormick I think looks pretty good as an alternative to holding aggressive stocks. Next up is Kellogg. Let's pull Kellogg up here and scroll back. Look at this, Kellogg up 65% of August's. That's 13 of the last 20 years with an average return of 1%. Well, what's going on in the chart? Are we getting confirmation? And you can see that we are big breakout here, beautiful consolidation and so forth. So this is how I would go along and try to do the, use the seasonality in conjunction with the technicals. I wouldn't favor seasonality over the technicals, use them together. So let's just do a quick summary of the things that we just talked about. And then we will get into the 10 in 10. And there is your seasonality. And the things that's basically what I try to go over each month as we take a look at seasonality. Again, I think probably the most important thing to take away from this is that it's a tool. It is not the be all end all. It is not, I would not be buying stocks strictly based on seasonality. I think we have to be a little bit more precise than that. So I would continue to look at other areas like the technical charts, the relative strength, all those things I think is what really is going to be important as we go forward. All right, it is time to jump into the 10 in 10. So I'm going to start with the first stock, which is SurveyMonkey. I like this chart actually a lot. It is in software. I'm going to pull up this chart. I think we're starting to see nice relative strength. We gapped up above resistance, went below it, and now we're coming back up above it again, which I think is bullish. Let's see how we close today. Volume is going to be strong. Here's software. We already know software is a great group to be, but look at the relative strength now picking back up again. If we could get a breakout above this double top, and at the same time, since going public, we have not seen SurveyMonkey close or move intraday even above 20. A close above 20 would be something that I would be watching for very closely. As far as closes go, this was the highest close we ever had. We're above that right now. So I think this 1920 area is really important, but I like SurveyMonkey. I think you want to keep this one on your radar.
Tandem.
I'm sorry, what was that?
TNDM, Tandem.
Okay.
The diabetics.
Yeah, they came out with earnings and they were pretty good earnings that we got a gap up. Of course, the market is just so weak. It's really hard for a number of these companies, really, unless they're in breakout mode. I think a lot of them are having problems sustaining their move. I think Tandem continues to consolidate. I still like it. I think this 60 area, I think I've talked about this quite a bit here. Multiple tests around 60, and I could even draw another line here around the 62.5 area. Multiple tests down here in this area. We just did it again before earnings. We gapped up, and we're still in the trading range. We need that breakout above 75, but as long as it stays in this trading range, I think the stock's a buy close to 60.
All right, next one, semiconductor, AMD, Advanced Micro.
All right, AMD. Yeah, this is one that's kind of fallen apart. I'm really watching that June low. On a relative strength, we are still holding on the S&P, but we're not on the semiconductors. And what I'm referring to are the recent lows, relative lows. So right there, you can see this relative low. We broke below it. This relative low versus the S&P is holding so far, and it's because we've had pretty good relative strength in the semiconductor space. So what I would look for is the semis to turn back higher, and I think the next big test for AMD is, do they lead the semiconductor group on the next push to the upside? I would keep watching this price support. If I was in it, we bounced off 29. You got a series of higher highs and higher lows. I think that 29 level is really important here. So that's what I'd keep my eye on.
All right, next one is a retailer. They came in with good numbers, but guide it lower. ETSY.
Yeah, Etsy is definitely one that I've continued to watch. I think continued until today to perform okay versus the S&P. You can see it's kind of holding up, but among its peers, which have been outperforming the S&P 500, it's been going lower for a while. So maybe that's a little bit of a warning sign. And now today the stock's down 11% with big volume. I would probably have to avoid this one for now. Maybe if you're, if you like the stock technically from a key price support perspective, I don't think I would touch it unless we got a reversal down near that 57.50 area.
All right. Then we have another semiconductor, KLAC.
All right. Now this one on a relative basis looks a lot better than say AMD when, we're seeing the relative strength falling apart there. A number of these semi-equipment companies I think are performing really well. There's a gap support area. And then also anytime I get a move like this and come back, first test of that 20-day, a lot of times is a good one. Volume trends I think look great. I don't really see any negativity here on this chart at all. So yeah, I like KLAC as part of the semiconductor space.
Now we have a marijuana stock, HPHA. They're really moving the group today.
All right, I guess HPHA?
APHA, sorry about that. Andrew, Paul, Harry, Andrew.
All right. Yeah, this is a big move today. It's been downtrending, huge volume. Let's see, what is this considered part? They don't have it. I was thinking maybe
consumer products.
Oh, is it consumer? Okay, I would say first of all, it looks like it's breaking out of this downtrend. I can probably just go back to that other chart, and I do want to stretch it out though. All right. So I think in the short term, what I would be looking at here is the highs coming down here that were, so that's a 4 or 5 month relative trend line that going lower. And I could even drag this probably down here. And I don't know, it doesn't really line up there, but I could maybe have said that that was a little bit of a channel that it was in that it broke out of. The other thing to watch though is a longer term trend line where I would connect this high with this high. And if you notice, this one hasn't broken yet. And in addition to that, as I look at this, we've got some key highs that we want to watch for. Here was a big move late January, early February. You can see this prior low gap resistance. We broke above it, came back down, went beneath it, and look at where we have failed in May and June, right at this 775 area, which is the trend line resistance. So if I was in it and I got up into anywhere near this area, I'd probably take profits and see whether or not we could break out and whether this PPO goes positive. Until then, like right now, with it up 36% today, I wouldn't want any parts of it if I wasn't already in it.
All right. Next one is a biotech, TWST, that reported. I would take a look at their late April report and how they responded at that time.
TWST?
You got it. Twist Bioscience.
Yeah, big move down, and clearly this is overhead resistance. And I want to tell you, this is one of the candles I think is so important to understand, where when you have a potential breakout, see these tops right in here? Look at that move 2 days ago. So back on Wednesday, we were up to $36. We reversed off of it. I think when you have a false breakout like that, it's a sign of distribution, and you want to be very careful in the near term. So it's pulled back. If it holds the 20-day and can go back up and break out, very bullish. If it fails to hold on the 20-day, I'd be careful.
Very good. Then we have trucking company USAK.
All right. Yeah, I can just look at a relative chart here quickly, but I can tell you already with what the market's doing, I have no interest in this. I'm not a knife catcher. That falling knife theory, I have no interest in trying to capture those. And I mean, look at this. I mean, that, and then the relative charts. I mean, this is the exact opposite really of what I'm interested in. So I'm not at all a fan. If I was going to go into truckers, I'd be looking at something else. I'm not interested in USAK.
All right. Next one is the ETF for healthcare, XLV.
All right, XLV from a seasonality perspective, I didn't mention it, but it does tend to lag in the month of August, and it is in a downtrend. We are failing to hold on to some gap support, or excuse me, some price support. So I think until we got back up above the moving averages, you can see right there we had resistance, broke out. Notice we kept holding support, and now we're below it. And look at what's going on every time we try to rally. See these failures at the 20-day? See the negative, the PPO turn negative? I'd have to see this move back up above the 20 and regain some strength. Until then, I would avoid it.
Okay, last one. It's a computer tech company. It's PRSP, Perspective.
Yeah, this is a company that I like, but on a relative basis, it hasn't been a great performer in this space. It's in that software area. So the software going up, this stock hasn't really been going up, and look at the relative strength. So the volume trends look good, and it certainly seemed as though maybe it was poised to go higher. But as it turns back down, I would really pay close attention to this 2275 area. I think if you close below it, given the negative relative strength, I don't care about the volume trends. If you can't hold price support and you got negative relative strength or relative weakness, then I would be getting out. So I'd watch this pretty closely to the downside here. And that is your 10 in 10. As you can see on your screen, those are the 10 stocks that I just covered, and that will be in the MarketWatchers live blog later today.
Very
All right,
good.
Mary Ellen, we got a weak market here,
Mm-hmm.
and we did a poll. I think it's time maybe to take a look at it. We got the Dow Jones right now down 200 more points, NASDAQ down 127, S&P down another 1%. S&P's fallen 100 points in less than 48 hours. So here's the poll question. Since the Fed meeting and with renewed trade tweets, the S&P 500 has lost 100 points. How long will this latest episode of selling last? And it looks like the majority of the folks here believe the seasonality will hold true and that we're going to consolidate further over these next 1 to 2 months. What do you think?
Yeah, I think I would go with that, because primarily when you look at the reported numbers for a lot of these companies, they're coming in over 82% are coming in ahead of estimates. They're showing solid growth. And even on the economic front, the economy, well, albeit not at a fast pace, but we are still seeing continued growth. So we have that platform. It's really right now all about sentiment. That's what's driving the markets. So depending on the tweet of the day or the news of the day, we're in those summer month periods where there is less volume by nature. Traders are heading to the beach earlier, so you are more susceptible to these types of swings. But I think at the end of the day, we will most certainly resume that uptrend.
Yeah, I'm between the number one and the number two response. I think it could be consolidation. I think we also could very quickly resume the bull market. And I wanted to pull up, just show you this chart quickly here on the S&P. This is a weekly chart. And a lot of times when you're in an uptrend and you break out, notice that 20-week moving average serves as pretty good support. And we're just breaking out again here. So this could serve as the support. We just launch and go higher. I think the number to watch to the downside is that 10% correction level. I think if we break below this double bottom at about 27.28, 27.30, that's going to be a problem for the market. Otherwise, I believe we either consolidate and go higher, or maybe we just bounce right off of it. We'll have to wait to see.
Yeah, we're at critical levels now, certainly on the NASDAQ and the S&P, trading right down to their 50-day simple moving average, which is a very widely watched metric. So that's another psychological level to pay attention to.
It is time to wrap up for another week. There's your upcoming schedule. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Have a great Friday afternoon, everybody. Be safe, and we will see you back here on Monday. Happy trading.